I believe you guys have listened to Michelle's sharing on retirement planning. I hope that's beneficial to all of you and understand why and how do we do the retirement planning. Let's start our next topic called wealth management. I'm Gifford. Welcome to Eduhk Internship again. So what is wealth management? Wealth management is not just investment. While investment aims for highest return with lowest calculated risk in a particular tool, wealth management talks about the asset allocation in a holistic way. It's a very interesting and sophisticated topic that even a few days are not enough to share all the bases. It's a lifelong journey, but still after all, it's the game of balancing two R's, risk and return. So what is return? Return is the capital gain after you buy some investment and then sell it. The difference between the selling price and your buying price is the capital gain. Or it's kind of an interest income, just like you, for example, you just put $1 million in the bank and the bank gives you 1% interest per year, which means you get $10,000 per year. So this kind of interest income is also called return. So just make it clear, return consists of the capital gain and the interest income. Sometimes we have different names to describe this kind of interest income. Say if you put the money in the bank, you call it that interest. You put the money in the stocks market, you call that dividend. You put it in the bonds market, you call that coupon. You put that in the insurance policy, it's also called dividend. So just different names, but basically the nature is the interest income. Someone may ask, how about if I buy real estate? Where's the return? The rental return actually is the rents you collect each month from your tenant. That is kind of the interest income of the investment. But for the capital gain is the selling price minus the buying price. Sometimes it's not just the capital gain, but this is the capital loss. We call that negative return. Let's talk about another R, risk. So what is risk? Risk is simply the measurement of how uncertain you can get the return. In other words, it's measurement of the probability. In financial terms, it's the chance that an outcome or an investment actual gains will differ from the expected return. That's how actual life works. We always face the uncertainty, and therefore there are crises happen again and again. So why don't we introduce the wealth management tools from the history of crisis? That's what I'd like to share with all of you in the coming slides. Let's get started in the story mode. This is a timeline of world economic history. From Stone Age, their invention of currency, then become precious metal currency like gold. Then someone in China invented paper currency. The first public traded company, the establishment of gold standard, and the establishment of the Federal Reserve, and the internet is created, and the trade war began. What can you discover from this graph? Simply shows that the economy is keep on increasing and expanding throughout the history. But how can we capture the economic growth? The economic growth is based on the technology and the economic activities. So the tools that capture the economic growth so that can beneficial to ourselves is called the wealth management tools. If that's just simple, why don't we just keep on investing? No, because if we look a little bit closer, we will know Actually, there are ups and downs, and that's why we need wealth management tools, and different tools have different direction and properties that can help diversify the risk. As you can see when we look a little bit closer right now here to see over the past 200 years. This graph shows the history of the United States Treasury yield. In case you don't know what US Treasury is, it's kind of agreement that the US government borrows money from investors, or commonly known as bonds. So let's focus in the series of the events shown. Since 100 years ago, we have World War I, we have World War II, we have Great Depressions, Korean War, Vietnam War, oil shock and crisis, Iran hot state crisis, the dissolve of Soviet Union, Asian financial crisis, in the year of 2000, dot-com bubbles, in 2008, financial tsunami, and numerous recession in between. So you can see the graph going up and going down, going up and going down. If you look further backwards in the 19th century, actually the situation almost simply the same. What's the inspiration? The inspiration is the economy will keep on growing afterwards, despite every time people believe it's the end of the world. This time is different. Everyone kept saying that. But history always repeats itself, especially in terms of finance, because we humans are quite irrational. Look at the recent history of financial tsunami. During the financial tsunami, over 65 banks go bankrupt. But at the same time, insurance companies not affected. Because from the point of view of the government, insurance companies are much more important to the stability to the financial system, since many banks are also insured by the insurance company. Therefore, the government chose to save the insurance company. They even list a list of too big to be failed, so that the world can survive from the crisis. And that's how we recover from the financial crisis. As a civilization, we survive. But how about individuals? Many individuals and their families lose their jobs. Some pension funds go bankrupt, and all of their clients' retirement fund simply gone. There is a famous bank in Hong Kong. Its stocks drops from $125 to $28 within a few months. We can see lack of wealth management cause disasters for families. Some of them have to work extra 10 years more for the retirement. Some of them may even not be able to get back to their previous financial position. The world will recover. Families may not. It's our job to help them to use proper tools to manage, and more importantly, proper percentage of asset allocation. Crises happen all over the world, not just for the United States or China, but also Europe, but also South America, also Middle East, also India, also Southeast Asia. There are lots of places in the world gone through financial crisis in just a few years' time. I won't go through the details. If you're interested, you may research further. And I encourage you guys to research further. Because as you can see, in the past 2 decades, there are over 20-something financial crises all over the world. Simply search in Wikipedia and you will find it. Charlie Munger said, "If I know where I'm gonna die, I won't go there." It's so simple to have a better wealth management by simply avoid the mistakes those people make. This is the lesson we all have to learn. But very often, we didn't. Let me show you the classic example. It happens 300 years ago, and we still didn't learn very much from that. One day, from insider news from someone close to the royal family and other inner circles of the richest, the South Sea Company in England has got the monopoly rights to trade with the Latin Americans. Think about it. At that time, it means the monopoly of the luxury goods means there is great potential for this company to grow. As individuals, how can we share the profits earned? By buying its shares. The company needs money to operate its ships, but the bank thinks it's too risky. Therefore, the owner are selling the shares to the public to fund its business. The first time the company goes public, we call that IPO. When people are optimistic about this opportunity, they often want to buy more. This makes the price of the share goes up. Investor A thinks, I don't want to wait for the ships to go out to America and comes back. Why don't I just sell to investor B who are willing to offer a higher price than my purchase price? This kind of second-hand market is just like the stock market we are seeing in the modern times. It's just a simplified version. The situation of this South Sea Company continues, and the price goes up and up like the graph you see on the right side. And one day, out of no reason, the monopoly grant has been confirmed. Further drives of the price. Sooner or later, somehow people discover that the Atlantic Ocean actually is still controlled by the Spanish Navy. And at that point, the bubble bursts. So what is a stock? A stock is the listed public company that enables investors to buy its shares so that they can trade second-hand with each other to grasp the opportunity of the capital gain or capital loss. And at the same time, the fundamental nature of the stock is to do the investment so that when the company earns profit, it divides the profits and share the company profits to the investors, which we call dividend. However, due to our human nature, very often this kind of investment becomes speculation. And this South Sea bubble is a classic example that repeat almost every time in every market. Not every company is a bubble. Some of them are very good. Some of them are long-lasting. Some of them may create a very good products and service and benefits to the society. But once in a while, there are some companies that actually is a bubble. So you may discover that in daily lives as well. From this graph, you can see the psychology of a typical stock investors or speculators. One of them is very famous scientist, Newton. If we calculate the IRR of the index in the previous decades, we can see a promising annual return. So what is IRR? Actually, it's the compound interest. However, majority of the investors suffered from the financial loss due to our wild psychology. So that's how it works. As you can see in the graph on the left-hand side, usually we are skeptical in new opportunities, and therefore when opportunity arises, we invest a little bit. And then we have a little gain. And we sell the stocks or the shares very happily. So that, I earned some money. That's really feel great. As time goes by, and you discover that your friends didn't exit. And more importantly, your friends get rich and rich and richer. And finally, when the atmosphere becomes very, very optimistic, and everyone say this is the opportunity, you cannot miss it. People will re-enter the market and buy a lot. And that's when the stock market crash. Remember, the keyword of stock as wealth management tool is share. The nature of the stock is to share the company profits, not for speculations. If we are a long-term investor in stock, we must consider the effects of shorter business cycle and short life of big companies, as mentioned in day one's video. Remember the incident of Kodak and Nokia. Both are very famous, both are very large, successful, big companies and multinational companies before. But once in a while, the business model gone and everything becomes nothing. Nothing in the sense that if you invest in their stocks, if the company doesn't do the right thing or the trend doesn't fit the company, the stock price simply goes down and you can never come back again. Finding a single company that can survive and keep on growing is not that easy. Not to think so is naive. Therefore, in wealth management, diversification is the key to secure and guarantee the objective in life stage planning. To make sure the objective from your life stage planning can be achieved. And we should all beware of over-investing. Now let's talk about real estate. This is a trend of Hong Kong's Central City Index, HKCCI, which reflects the house price, residential house price. You can see the price goes up from 92 to 97, drops from 97 to 2003, and goes up again until 2014, and actually the story continues to goes up in 2016, a little drop, and then go up again. The real question is, when the bear market is coming, can we survive? From 1997 to 2003, there is almost a 70% drop in real estate price, and the recession caused a lot of jobs and financial securities issues. One may forced to sell their property investment, which happened a lot during that period. Just imagine a 5 million property, probably having 4 million of mortgage from the bank, and even worse, what if he is sick and cannot repay the mortgage? If the property values drops to 1.5 million, which means you still own the bank $2.5 million after selling the property. This is a complete disaster. This changes people's lives so badly, and therefore a wise financial planner will also help the client to take care of the risks and say, for example, make a good cover by insurance, can solve some fundamental risks from having sick or even passed away. So families can maintain their homes even during recession or crisis. The media said the real estate price will go up and up. How come they can say that? Every economic phenomenon is a cycle. It's just the way it is. Therefore, to be a successful management in your wealth, we have to see through things. We have to see through the cycles. When the spring comes, and then it's the summer. After that will be autumn, and then after that will be winter. We just simply can't change that. At the same time, it's just like the real estate market. When there is recession, and then there's expansion. When the expansion goes long enough, it becomes recession. It's just inevitable. The question is, how long does it gonna take? This graph shows the curve for the real estate prices of Tokyo in Japan and other major cities. The red line shows the 6 biggest cities, which the most famous one, Tokyo, Osaka. The blue line is the rest of Japan. So this shows the economic growth from 1970s to 1990s, whereas Japan is the rising stars of the world economy. At that time, there's a book called Japan Can Say No. The Japan is challenging the America for the biggest economy in the world. But we all know the results, right? It just gone through a very, very long recession. Somehow, someday, I believe it will recover from the downturn, even if the graph is stiff like that. But our lifespan is limited. Our time is limited. If I invest in Japanese property, especially in those promising cities during the 1990s, the price just cannot be recovered in 2009, not even 2019. Therefore, the keyword of real estate actually is location. Pick a location with good timing will yield you a good result. We must learn to distinguish other people's achievement, whether his achievement is based on luck, or based on the trend, or based on the wisdom. We must learn to distinguish that. Because when the expansion comes, everyone would be fantastic, marvelous investors. And the media will just keep on saying that. But that's not what we have learned. What we have learned is no matter which wind directions comes, we know how to set the sail to go to the destination, which the destination is definitely not having more and more and more money. The destination is fulfill the objective and our goals during our different life stages, because that's what brings happiness. That's what brings satisfaction to people. The third tool we would like to introduce is bonds. The keyword is borrow. The US Treasury bills means the US government borrow money from you and pay you interest. From your point of view, the interest they pay you is your return. What if they don't pay you money? We call it default, and you lose your principal plus interest. From companies to government, they can issue bonds to borrow money, and therefore the risk is different. In general, small companies have higher risk of default, as their financial strength is weaker than the large companies. Therefore, they need to pay high interest to raise funds from the investors. From the investor point of view, that is high return. The yield or the return, the interest as a bond who pays you, we call that coupon. Strong nations has lower risk of default, and weak nations has high risk of default. The recent financial crisis of European countries is originated by the public loans the government cannot repay their debts. Countries like Spain, Ireland, Iceland suffered, and the emotions spread to all over the world. As shown in the graph, the yields of the US Treasury bonds actually also goes ups and down. Other investments? There are many alternatives, from timberland, gold, cryptocurrency, commodities, wine, artwork, venture capital, P2P lending, you can name it. There's a lot. But we have to understand it. We have to understand when we invest in this alternative investment, are we looking for the return from the capital gain? Or we are looking for the return for the interest? That's totally different. Besides, many of the alternative investments are not regulated. Not regulated in a sense is not regulated by the government, and therefore as investors the risks are even higher to invest them. And let's look at the reality. The reality is each year there are some markets outperform the others. The champion of 2013 doesn't mean the result will be the same in 2014. Therefore, it's a profession to play the game in the arena. If you are the fund manager, go for it. Or else, it's just like wearing nothing to fight with fully geared warrior in the battlefield. Just see how much chance an individual could win versus those professional institutions. Because we just can't time the market. And if one day someone said to you, he can time the market, he can make sure you can win the bet, be careful. Really, really be careful. Because probably not. Probably he can't do it. And all we have to do is to construct a portfolio based on life stage planning so as to fulfill what we need and balance the risk and return and make sure it is diversified enough so therefore some particular risk for a particular company won't affect you. Here you can see the spectrum of risks and rewards. So from the lower parts, the government bonds is the most safe asset in the world, theoretically. And of course, there are different governments, right? The governments from the United States versus government from Somalia or some African countries is totally different. And therefore, there are different kinds of... here in general, the government bonds means those developed countries. And of course, insurance cash value, because it's highly regulated by the government and backed by reinsurance company. And of course, saving accounts of bank accounts. And also certificates of deposit, insurance policy, dividend, corporate bonds, mutual funds, blue chip stocks. And as the ladder goes higher, so as the risk level. But of course, the return, the potential return may be greater. It's just we never know. That's all for today, Wealth Management Tools section. Thank you for your listening. I hope today can give you a brief overview on stocks, bonds, real estate, as well as some alternative investment. Of course, they are not in the details, but you will know there is such categories. By understanding these categories, I hope if you are interested, go to the internet, do some research, and you will find many information that you need. Nowadays, we don't lack of information, we just lack of organizing. We don't lack of details, but we lack of categories. We don't lack of competence, but we lack of ambition. We don't lack of curiosity, but we lack of determinations. I hope you guys have the ambitions and determinations to at least during that period understand these financial concepts. I believe that will be beneficial to your whole life. Thank you.